Hello and welcome. You're watching KYC. I'm Harsh Saita, and when a company worth 1500 crore in terms of market cap wins a potential 6 to 700 crore in top line, it certainly rolls a few eyes, and it ought to, right? It's understandable. We're going to be speaking to Signpost India today. It's a very, very small company in relative terms to the companies we speak with, but it's an interesting one because of what I just said. And what I want to know in particular is with regard to, one, their win today, which is around 700 crore in terms of revenue potential over the next 9 years. Even if I broadly extrapolate that to 70 to 80 crore, they've also done another, or rather they've had another big win, which is the Karnataka win. So it's the Karnataka plus the Bangalore Metro wins, which are cumulatively adding around 150 crore in top line annually. That's the broad-based ballpark that is being penciled in. So you want to wait and watch as to whether that actually plays out like the way we're thinking it will, and what after that, what the margins on the business that they are winning is going to be like. So that's number two that I want to know. What are the margins like on the wins? They do 20% plus typically. I'd want to know whether they can maintain that kind of a clip. The third one is, of course, you've won Bangalore as a big metro, but could you win Mumbai and Delhi? Because those could be larger wins, given that the new Mumbai metro is coming in thick and fast. Those could well be potential wins for something like a Signpost India, and it could add to the potential top line and the growth that one is penciling in. And mind you, it's a 450 odd crore top line that you're all talking about. So already a 30% growth that we're seeing, and with the potential of that this might hold, and I want to understand how realistic that is, it could well be a tilter in favor of the way one looks at the company. The fourth one is what will take it to win. So say one is that they come out and they say that they are super confident about winning this. How is competition looking at it? How strong is competition in this space? And what will it take? What is it? What are the key factors that they are looking at which give them the confidence that that win is possible? Because for you, the viewer or the investor, or for me, the analyst, it's important to understand what the risks are as well. The fifth piece is understanding the working capital cycle in the business. It's been a bit choppy where cash flow is concerned. We'll talk about that. While the last couple of years has been decent, but I'd want to know whether we can really see an ironed out cash flow coming straight through, or is there something which will get locked in working capital as they start to win these large contracts. The sixth piece is with regard to capex. Does their business require it, and therefore what's the funding outlook? Because I've started to see debt increase in the system. So I'd want to know whether that could continue or not, or will we see actually a pay down with regard to where debt is concerned, and then just overall trying to get a sense of what the risks in the business are looking like. So, and that is also a bit with regard to how the conversation goes and what's the pulse we all get as part of that conversation. So we'll try and understand that, because mind you, it's a 1500 crore market cap company. So you want to be careful, right? Just blindly considering it will be a tough one. Now let's look at the company itself. It was incorporated in 2008. Signpost India is a merger of two companies in 2023, thereafter listing in 2024. But it was incorporated originally in 2008. It's a digital out-of-home and integrated advertising company. The company focuses on long-term government contracts currently. It combines advertising with public amenities like bus shelters and the like, and I'll talk a little bit about that. And it currently manages around 33.9 million square feet of ad space. So that's the broad brush understanding. Now let's talk about specific services that they provide. One is the digital out-of-home advertising, as one should call it. This includes largely dynamic digital boards. You would have seen it on highways, and it's a slightly high margin kind of a business, uses AI and data analytics. It's used across, say, airports, metros, city centers, highways, as I did mention. The second piece is transit advertising. That is advertising on bus shelters, inside buses at airports. At slightly medium to high margin is the sense that we get. The third piece is mobility advertising. Campaigns on moving vehicles, like bicycles, vans, stuff like that. And that advertising also is something that they handle. And Uber having a small billboard at the top, you might have seen that on a few Ubers and certain other vehicles, and that also is part of advertising. Now you look at the conventional out-of-home service. This is a slightly lower margin business. It includes static billboards, street furniture, traditional formats broadly is what this one deals with. And then there's design and content lab. This is more custom creative solutions which advertisers require. So they deal with a whole host of things. But the largest chunk of it is the first one, which is the digital advertising, which is out-of-home advertising. Now let me talk about the business model broadly. It wins long leases or ad rights through tenders that they give, and this is generally to governments and municipalities that they generally work with. And then they install and maintain advertising infrastructure which is handed over to them. They sell ad space also to large brands, agencies, and ensure that that tie-in happens, agency to government. And then thereafter, they ensure that there is monetization via display occupancy, asset scale, price optimization. So all of that is what they kind of work around. That's the broad brush understanding of how the business works, and you would have seen it in real life and therefore able to relate to it far better than those graphics which are on your screen. So broadly, that's the way to take it. Now let's talk about the key metrics that we'll discuss today. Now it's a very, very small company, but nonetheless, we'll pull out the metrics that we'll look at: income statement, balance sheet, cash flow, return ratios, shareholding, street cred, street coverage, outlook. So we'll try and cover all of that. We do have the valuation picture, but it's tough to determine, right? It's not exactly as easy to figure out the valuation. So broadly, that's how we'll take it. Let's start off with the income statement, and that will also give us a picture on how the valuation has evolved. Around 40 crore odd of profit after tax, which they've clocked in FY25, leading to approximately 40 times earnings. Broadly is the valuation at which they trade at. Your revenue has grown fairly okay. EBITDA also around 30% growth over the last 2 years, maybe cumulative. But you look at the margins, they've shrunk just a wee bit. Net profit, though, absolutely flat. And I'll talk a little bit about that trend, which is what may just be a bit of a concern. It's actually the increase in depreciation cost which has led to a lid that they've had to keep with regard to their profit after tax. So this is a non-cash expenditure which is leading to a shrink with regard to the profit before tax, which is impacting the profit after tax as well. So that's something you want to keep in mind, that it's actually depreciation which is hurting profitability. But broadly, that's how it shapes up. This is Q1 FY26 performance of a very, very low base. That's the QOQ growth number. The YOY growth also decently healthy, and an annualized 60 odd crore of profit after tax. So it's gotten slightly better where Q1 FY26 is concerned. You want to understand sustainability of that kind of number. Again, this 38% revenue growth looking quite healthy in that sense. But we've given this a neutral only from a perspective that this ballooning of debt cost is leading to profit outcomes which are far from ideal. So you want to wait and watch as to how that plays out and what the reasons for that could be going forward. Mind you, there is no guidance that this company has given, and hence difficult to kind of extrapolate what this could look like going forward. So we'll probably be one of the first few to understand this better. Let's also now go to the balance sheet, and you're looking at equity capital plus reserves, which are decently healthy in that sense. Let's pull out those numbers if we can. So there you go. So you've got that book value of around 221 odd crore. The borrowing number has gone up, as you can see, visibly gone up over the last couple of years. I'd want to know where this goes. But what is the reason why I'm not too worried? One is you've got a healthy cash balance of around 50 crore, which is a third of the borrowing number. So it kind of takes care to some extent of that borrowing. Also, the EBITDA, the annual EBITDA number sits at around 90 odd crore, which is operating profit before interest and taxes. If I remove interest and I remove taxes, which is typically the cash element of this entire picture, then you're broadly getting a 50 crore odd number. So not looking bad per se. 50 crore cash, 50 crore annual EBITDA, which or rather post interest and post cash expenses kind of earnings, and therefore this gives you a decent picture as to how borrowing is going. Now the only possible risk here is if your working capital need balloons all of a sudden, which is why that big question on working capital, and that will also have an impact on the balance sheet. So we've again been conservative here with great difficulty given this a neutral, but broadly that's the way one ought to think about it. Borrowing could become a problem. Mind you, companies only start facing huge issues even in bad cycles largely because of borrowing. So if that borrowing number is elevated, you have to be worried. Again, we'll ask that question to management and get a better perspective of that as well. Let me talk about cash flow now. And when you're looking at cash flow to profit after tax, largely the ratios are quite healthy. There's been a large reversal which has happened in FY24. You can see how CFO to PAT has just doubled. It's 2x of what the PAT is, which is positive, but that's largely because of the drag we've seen in FY23. So FY24 has gotten much, much better. FY25 largely steady state, around 80 odd %. That's the broad take with regard to how CFO to PAT is. But given that you've seen a large ballooning of depreciation, you would ideally have expected that your cash flow from operations, even in FY25, was far healthier than profit after tax, right? That's generally the norm. 20 crore worth of depreciation expense, and we're not seeing the benefit of that on cash flow from operating activities. So that might also be a bit of a concern, trying to understand all of that. But it's largely because working capital needs have really ballooned, and that's where the concern lies. I'd want to know whether that is realistic and sustainable. Now, the fourth piece, or that's just part of the business, how should one look at it? Now, let's talk about return ratios. Return ratios are in that 15 to 24% band at this point. Again, you want to start to understand sustainability of this over a period of years. So I'd want to wait and watch even with regard to return ratios. A large part of that will be linked to profitability, of course, and capex. So both of that will be slightly more important to understand, and we will try and understand that. So that's on return ratios. Now let's talk about shareholding. 75% promoter owned, no concerns there, and therefore we've given this a thumbs up. The number of shareholders also largely has gone up. It's on an upward trend from 11,000 odd shareholders in FY24. It's up to around 16,500 shareholders currently. So the number of shareholders has gone up, something that you want to keep in mind broadly. Now let's talk about street cred. It's been choppy for a shareholder who's holding this. 24% 1 month, but year to date the stock is down. 6 months the stock is up. And when you're looking at the 2-year performance, which is since listing, which is Feb of 2024, again, it's been difficult. So we've, again, not been able to point a direction, but the returns and the fluctuations have been strong. So you want to be careful, and therefore we've given this one a neutral as well. Let me talk now about what the street coverage looks like. There is one very, very small brokerage which is covering this one, and therefore there's nothing meaningful here. We, of course, have to therefore give this a thumbs down. Unfortunately, this is the only one, and it's understandable. 1,500 crore market cap, generally not covered by too many analysts, and it's understandable, and therefore we've given this a thumbs down. Last, on the outlook piece, and there's plenty to do with regard to where the outlook is concerned. I did speak a lot about it already, but they've received exclusive advertising rights for all 67 metro stations by the Bangalore Metro. It's an SPV, or rather a JV formed between the government of Karnataka and government of India, and the expected revenue potential is around 700 odd crore. It will attract around 3 crore of monthly ridership, and the company has gained exclusive advertising rights for a 9-year tenure. So clearly positive with regard to this one. Also, let me talk about some developments in July of 2025. Now, in that regard, they've had a strategic exclusive agreement with Comor NB Tech Solutions Private Limited. The highlights of this is they've been granted exclusive rights for advertising and promotional activities across city flow buses, right? And this is of course a premium bus network. They've been granted exterior interior branding rights. It's an exclusive 5-year agreement. It's all positive in that sense, and the agreement commences with the deployment of 350 buses across key urban markets, including Mumbai Metropolitan, Thane, Hyderabad and Delhi. So it's multi-city as well. So that's the second big win. The third one is where the High Court has allowed the company to resume operations. The company has received an order enabling resumption of advertising operations in Bengaluru. The High Court nullified notices prior which had directed the company to dismantle advertising structures. All of that again positive. This should add another 70 crore to top line. So outlook looking good, but I want to try and understand this better and deeper, and we have with us Shripad Ashtekar, who's the managing director at Signpost. But just before that, let's quickly rate it on our KYC rating parameter, and what you'll see broadly is neutral ratings, but we've explained some of those ratings to you, and of course we'll have a better lens into that once we speak with Mr. Ashtekar, who's the managing director at Signpost. Let me go straight to him. So great having you. So let me start off with some of the wins you've had over the last maybe 2 to 3 months. Give us a clear picture. How much does this add annually to your top line, and how quickly does this revenue potential start to translate?
Thank you for having me. This recent wins, which includes more about the transit advertising, which we call in OOH, which is impacting the top line and even the bottom line. The addition has given a growth of around 25-26% the last quarter, and the similar pattern we see from the recent investment what we did in Bombay or in other markets in the country. So our focus area would be always around the transit, which is a more networked and more data-driven approach.
Got it. So how much should it add to top line? Sorry, sir, trying to understand that. And does it come in FY26? Do you expect 150 crore plus in terms of top line addition?
So this revenue, which we have projected for 9 years, will definitely start giving the yield from the second half of the year, and definitely it will be around the same number what you are talking about.
Understood. So maybe H2 onwards, so may not be the full 150 crore in year 1. So what about the Bangalore High Court order? How much does that add to your top line? Give us that perspective. That should add around 60-70 crore to top line as per disclosures.
Yeah, you're right. So basically, we should look at all the projects which is the High Court which has given the green signal to start with, which is around the traffic booths we have already installed, and the digitization of the panel around the junctions, and plus the Bangalore Metro what we are talking about. We recently signed the contract with BMRCL. So it is more about the traffic commuters. Currently is around 7 to 8 lakhs daily commuter in the Bangalore Metro, and which is going to double as the phase 2 started, which will be around 15 lakhs. So if you and the implementation and the sweet spot is about the tech savvy and young traffic, which will be in the metro commuters. So ideally, we would see the same growth which we have projected for around 700 crores within 9 years.
Got it. So what about the city flow contract? How much does that generate annually?
So it's a small contract as compared to the fleet what we operate nationally, which includes Chennai, Bangalore, Calcutta, Mumbai, Pune. But definitely the data-driven approach of city flow will be adding a lot of value in terms of the delivery part to the brand to get the more precise ROI. So the value proposition, it will be small because the number of buses operating, but it is growing right now. Like Hyderabad also has seen the growth in number of buses. So it's a small number, but it's around 2% or 2.5% to our total last year revenue.
Okay. So that's relatively smaller in comparison. So what is the potential coming in from Delhi and Mumbai Metro? Are those at all up for grabs? Are you in the running for it? and what is competition looking like? How likely are you to win it?
So Bombay already four lines are operating, out of which two we are already having the rights for 15 years, which is a line number 7 and line number 2A, and we have the exclusive rights for 15 years for the two lines. And upcoming lines definitely we will be participating, which is more towards the exterior part of the infrastructure of metros in Mumbai, and Delhi also will be focusing on to improve.
When did the revenue for this start to come to you? Was it Q1 FY26 or before?
No, as I say in out of hope, whatever we start, see, it's a contract for long term, right? So whenever we implement the phase-wise implementation, the revenue starts from that spaces. So suppose out of 67 stations, if we start implementing around 10 stations within 3 months, so the revenue from 10 stations will start coming, and subsequently the same phase-wise we will be completing that.
Got it. Okay. What is the margin typically that you operate at, and what is the revenue potential from the likely wins you can have from a Mumbai or a Delhi? Just give us those two numbers broadly.
So overall transit, which has a projection of 4,000 crores revenue by 2027, and currently what we have is around 10-15% out of that. So the growth pattern, what we see with the recent wins and the other contracts which are operating, where the investment has already gone, the bus shelters network in Mumbai, you see the huge difference in terms of quality and the implementation, what we did, including the design part, which has been recognized globally. But as you see the projection or the growth as a DOH market in India will be around 25 to 30% because of the digital and technology and the what we call it as a phygital also. So this growth pattern will definitely add the numbers to the contracts where we have already invested in last two years, and the same pattern what we are talking around the Bangalore or Mumbai will be under the same umbrella.
Trying to understand margins and profitability, would your margin number broadly be 20 to 22% across cycles, or would you see choppiness on the margin front? Also on profitability, what's the kind of growth expectation given that you already have very good visibility with regard to your top line?
So pattern will be the same what we have achieved in quarter one. It will not be a model which we have seen the numbers which we have seen in last year quarter four because of the implementation and the buyouts of the projects which we are under the implementation and started giving the revenue from Q1. So you will see the similar kind of a growth which we have already achieved in Q1, which is normally expected as a low quarter for advertising revenue because a lot of PSU starts budgeting their yearly budgets from July onwards. So we will see the festive time and the growth pattern what we have seen.
Understood.
In Q1.
So trying to understand working capital, because that's been a bit of a drag where the cash flow is concerned. Is this normal part of business? Has the last couple of years been tough for you from a working capital side of things? Also, what's the capex looking like? Is this a heavy capex kind of industry? Give us that perspective.
So all the contracts which has a long-term tenure requires an initial investment, capital investment of let's say if you talk about Bangalore Metro, which will be around 75 to 85 crores initial capital investment, which includes your infrastructure or digitization or improvising the spaces, well-lit spaces. So that kind of a revenue which is required to invest initially for initial period, but subsequently the growth pattern and the revenue starts coming. It's a win-win for both.
Okay, all right. Okay, thank you so much for coming in and speaking with us and giving us that perspective. That's, of course, Mr. Shripad Ashtekar, who's the Managing Director at Signpost India, talking to us about everything that's playing out in the industry, but more importantly with Signpost India. And viewers, completely out of time on this edition of the show. From everyone who puts the show together, thanks so much for watching. Stay with us here on NDTV Profit. More action on the other side.